While the headlines keep counting missiles and measuring how many miles a strike traveled, the actual story is happening somewhere the cameras never point, in the spreadsheets of central banks and sovereign wealth funds from Riyadh to Abu Dhabi to Doha. That is where this war will actually be decided, not on a battlefield. Here is the question worth sitting with. Why has the United States been able to lose or badly bungle nearly every war it has fought since 1975, and walk away from each one still the most powerful country on earth? Vietnam ended in a helicopter lifting off a rooftop. Iraq ended in a country that still cannot reliably keep its lights on. Afghanistan ended with the same government the war started to remove back in charge within weeks. Libya is still, more than a decade later, functionally two countries pretending to be one. And yet, somehow none of that ever seemed to cost Washington its position at the center of the world economy. That is not luck. That is a design feature of a system built more than 50 years ago. And understanding that system is the only way to understand why this particular war in Iran might behave differently than all the ones before it. Let's go back to 1971, because almost nothing about the modern world makes sense without it. For roughly 25 years after the Second World War, the global financial order ran on something called the Bretton Woods system. Currencies were pegged to the dollar, and the dollar itself was pegged to gold at a fixed rate. It was in a real sense an honest system. If you held dollars, you held a claim on a specific weight of gold sitting in a vault in Kentucky. That arrangement worked well when the United States was the world's dominant creditor, exporting more than it imported, and running the kind of surpluses that let it comfortably back its currency with a metal it could not simply print more of. But by the late 1960s, the arithmetic had flipped. A costly war in Southeast Asia and expanding domestic spending had turned the United States from a creditor into a debtor, and foreign governments were increasingly showing up at the door asking to redeem their dollars for actual gold. A system built for a surplus nation cannot survive being run by a deficit nation indefinitely, and in August 1971, the president at the time simply closed the gold window. The dollar was set loose from gold entirely. What followed was not a return to normal. It was the birth of an entirely different kind of power. Freed from having to back its currency with anything except confidence, the United States discovered something remarkable. It could run trade deficits indefinitely, and rather than draining the country of wealth, those deficits became the engine of American financial dominance. Every dollar that left the country to buy a Japanese television or a German machine tool or, later, a container ship full of Chinese goods tended to find its way back into New York, into treasury bonds, into real estate, into the stock market. The rest of the world kept its savings parked in American assets, and that inflow of foreign capital is what allowed the United States to run enormous federal deficits, fund a global military presence, and still keep interest rates lower than its underlying fiscal position probably should have permitted. No previous empire worked quite this way. Rome extracted tribute directly. Britain extracted raw materials and controlled captive colonial markets. The American system after 1971 required something far less visible. It just needed the rest of the world to keep choosing to save in dollars. No soldier ever had to collect that payment at the point of a bayonet. 3. Oil is the piece that made this durable rather than theoretical. In the years following the 1973 oil embargo, the United States negotiated a quiet but consequential arrangement with Saudi Arabia and, by extension, the rest of OPEC, in which oil would be priced and sold in dollars globally. This meant that literally every country on earth that needed to buy energy needed to hold dollars to do it, which created a permanent, built-in demand for the currency that had nothing to do with how the American economy itself was performing on any given year. The Gulf monarchies, flush with oil revenue denominated in dollars, then recycled much of that revenue back into American Treasury securities and Western financial markets in exchange for security guarantees, advanced weapons systems, and a level of political protection that let ruling families in the region maintain power domestically. This is the part mainstream coverage tends to skip entirely. The relationship between Washington and the Gulf was never really about oil supply in the narrow sense. It was about recycling. Dollars go out to buy oil, dollars come back to buy treasuries and real estate and weapons, and the loop repeats. That loop, far more than any aircraft carrier group, is the actual foundation the American position in the world rests on. Now here's why the battlefield outcomes of the last 50 years mattered so little to that foundation. Vietnam was a military catastrophe, but it did not touch the dollar recycling system, because Japan and West Germany kept running trade surpluses and parking the proceeds in American assets, regardless of what was happening in Southeast Asia. Iraq was a strategic and moral disaster that cost trillions and produced a fractured, Iran-aligned government in Baghdad. And still, Gulf capital kept flowing into American markets afterward, largely undisturbed, because the security arrangement with the Gulf monarchies survived the war intact. Afghanistan ended in a rout, and again the recycling machine underneath kept humming, because nothing about that particular defeat threatened the basic bargain, protection in exchange for capital, that anchors the relationship with the oil-producing states. Losing a war, it turns out, does not damage American power if the loss does not touch the financial architecture underneath it. That is the actual lesson of the last half-century, and it is a lesson almost never stated plainly because it is uncomfortable. Military defeat and financial dominance can coexist indefinitely as long as they remain unconnected. Which brings us to Iran, and to why this conflict sits differently. A war against Iran does not happen in some isolated theater far from the machinery that actually sustains American power. It happens in the Persian Gulf itself, in the exact waters and airspace that the entire recycling arrangement depends on. Any prolonged conflict there raises the specter of disrupted shipping through the Strait of Hormuz, a choke point through which roughly a fifth of the world's oil transits. And it directly tests the credibility of the security guarantee that has anchored Gulf capital in American markets for half a century. If Gulf governments begin to conclude, even quietly, even without saying so publicly, that the American security umbrella is less reliable than it once was, that basing arrangements might not hold, that the United States might drag the region into instability rather than protect it from instability, the incentive to keep recycling their surpluses through American markets weakens. And unlike Vietnam or Iraq or Afghanistan, that particular incentive is not something that can simply be rebuilt afterward through a photo opportunity or a state visit. Trust in a security guarantee, once genuinely shaken, does not snap back to its old level just because the shooting stops. 3. There's a reason to watch, rather than headlines about strikes and casualty counts, the quieter signals coming out of central banking circles. Announcements of currency swap arrangements offered to Gulf governments that, on their face, make very little sense, because these are governments sitting on enormous sovereign reserves that do not need a modest credit facility from anyone. Read as a literal financial mechanism, such an offer is almost meaningless. Read as a signal aimed at the markets watching the relationship, it says something different. That policymakers are aware capital that was expected to keep flowing may not show up in the volumes or on the timeline that was previously assumed, and that they are prepared to paper over that gap publicly. Whether such a promise is actually deliverable at scale is a separate question, because unlike a central bank, the institutions making these gestures do not have unlimited room to make good on them. But the gesture itself tells you what is actually being worried about behind closed doors, and it is not the price of oil. It is the durability of the recycling loop that keeps American deficits financed. The scale of what has been on the table in recent years makes this even sharper. Gulf sovereign funds have committed hundreds of billions of dollars, with plans stretching into the trillions over time, toward American technology infrastructure, artificial intelligence data centers, and advanced weapons purchases, all of it premised on continued regional calm and an unbroken security relationship. None of that capital allocation logic survives a prolonged, destabilizing war well. Empty hotels in Gulf financial centers and disrupted regional air travel are not the environment in which enormous, long-horizon capital commitments get executed on schedule. If even a meaningful fraction of those planned flows into American treasuries, equities, and technology investment arrives late, arrives smaller, or does not arrive at all, That is not a rounding error in anyone's ledger. It is capital that was headed toward financing the American government's own borrowing, and pulling it out of that pipeline turns what looks like a regional security story into a story about the cost of financing American debt. None of this is helped by the domestic political picture. Polling throughout this conflict has consistently shown that a majority of the American public, including a majority of the political base that returned the current administration to office, wants this war ended rather than expanded. That is a genuinely unusual level of cross-partisan agreement in American politics, and it means the war is being prosecuted without the kind of durable public mandate that made previous, much longer conflicts politically sustainable for years at a stretch. A president fighting a war his own coalition did not ask for and increasingly wants ended is operating with less room to absorb financial shocks than one fighting a popular war, because there is no reservoir of public patience to draw on if markets start to wobble. So where does this actually leave the argument about American power going forward? It is worth being precise here, because there is a difference between describing how a system works and endorsing that system, or predicting its collapse on a specific timeline. Nobody serious can tell you the exact date on which a financial arrangement built over 50 years either quietly renegotiates itself or breaks in a more disorderly fashion. What can be said with more confidence is this: the American position in the world has never really rested primarily on its ability to win wars. It has rested on its ability to keep the rest of the world's savings flowing through its financial system on favorable terms. Every previous military failure of the last half-century left that underlying arrangement untouched, which is exactly why those failures never translated into a broader loss of power. A war fought in the one region where the recycling machine itself physically sits is a different kind of risk entirely, not because of what happens on any single battlefield, but because of what it does to the willingness of the Gulf states to keep playing their half of a bargain struck in the 1970s. The question worth asking, then, is not who wins the next round of strikes or how the war in Iran is ultimately resolved on the ground. The question is whether the quieter machine underneath all of it, the one that turned 50 years of military misadventure into fuel for continued dominance rather than decline, still has enough trust left in the region that built it to keep running the way it always has.